Hi, welcome to Finke's free webinar, How to Start Surfing the Property Investment Market. My name is Tiffy Rubinet. I'm the co-founder and CEO for Finke. So I'm going to just jump straight into what we will be looking at today and what you can expect to get out of this session. I'm going to start by sharing with you when it's the best time to get started with your investments. Then you'll be able to understand whether property is the correct asset class for you. It might be property, it might be something else. You'll be able to have full clarity on what positive and negative gearing mean and which one of these strategies fits you best. Finally, you'll be able to understand how to earn money in growing and declining markets. Now, before we even proceed, I do want to mention that by the end of this free webinar, I will be making you an offer, and it's okay if you don't want to take the offer. I just wanted to be upfront and let you know. So I'm going to start by introducing myself. So I did mention that my name is Tiffy Rubinet, and for 7.5 years, I worked at a corporate job. I knew this job wasn't right for me, and one of the big things that kept me from quitting and moving was losing my stable income. I was really afraid of that. Now, 2018 was a massive year for me of self-discovery, where through a lot of doing exercises and reading books, I was able to understand what my life purpose is. And it's to help people who are not happy with their jobs transition to a life of fulfillment. I can do this in many different ways. And one of the ways in which I found I can help people is by enabling them to create their own profitable passive income streams. So they start gaining a little bit of financial freedom, which allows them to spend more time fulfilling their purpose. Now, in January 2019, I purchased my first investment property. And in my first 6 months as an investor, I was able to buy, renovate, and rent out 3 houses. Now, I didn't have enough money to start just by myself, but I was able to find investors without any prior experience. And all of my properties are seeing double-digit return on investment and yield, which is a really good return for my money. So I'm here to give you an introduction on how to start surfing the property investment market. And I'm gonna just start by talking a little bit more about passive income. Now, what does it mean? Passive income is not trading your time for money, right? So if I have to wake up and physically go to work, then that's active income. Now, passive income is when I'm getting paid, even if I choose not to go to work today, right? And the reason why it's so important is because it gives you the freedom to choose how you spend your time, and time is everything. So I want you to think about what's that one thing that you would start doing or do more of if money wasn't a constraint, right? Let's assume that we have a few rental properties, and the money coming into our bank account every month is enough to cover for our cost of living. Then we would have the choice of doing whatever it is. Maybe it's traveling more, maybe it's just leaving that job that doesn't fulfill us and we're not happy with. Maybe we have the dream of having our own home, helping others, helping out the planet, whatever cause we feel passionate about, or even just spending more time with our family. So just start thinking whilst we're going through this a 1 hour webinar about what is it that you would want to do more of or even start. So let's go straight into time, the power of time, and how time plays a key role in your investments. And for that, I'm going to introduce the concept of compound growth. Now, sounds fancy, promise it's not. And I'm going to use an example that was put together by JP Morgan, not myself, to explain how powerful time is within our investments. So in this example, they were doing this for, they've called it a savings account. Now, it could be anything. It could be a savings account or anything else that gives you a 7% annual return on your investment. Okay, so could be shares, could be anything. Now, in this first example, we have in that dotted gray line Susan, and Susan will invest $5,000 per year between ages 25 and 35. Okay, so over a 10-year period, which means that over those 10 years, the total amount she will put in savings is $50,000. Now, when she's 35, she stops putting money in, but anything that she's put in there, plus all of the returns that have been generating over that 10-year period, keep being reinvested. So by age 65, she has over $600,000 in that savings account. Okay, so this was just the money, the $50,000 plus all of the returns that kept reinvesting over the rest of the years. And then she is 65, close to retirement, and she wants to know how much she has on that savings account. Now, we have a second person, and his name is Bill. Bill is represented by the green line on the screen, and Bill will start 10 years later. Okay, so Susan started at age 25. Bill starts at age 35, and Bill will invest $5,000 per year, but instead of stopping 10 years after he started, he will keep going until he's 65 years old. So over a 30-year period, he's putting $5,000 a year, which means that over that whole period, it's a total of $150,000. Now, what's amazing is that even if he's putting there 3 times more money than Susan, by age 65, he has less money in that savings account. So he has $546,000 in there. Now, this is already that big warning on how a 10-year difference in your investments plays such a huge role. So it doesn't matter that Bill has put in there 3 times more money. Just by starting 10 years earlier, Susan is better off. Now, there's a third person in this example, and his name is Chris, and Chris is the blue line on the screen. Now, Chris will invest $5,000 per year, starting at age 25, and he never stops, right? So he does this over a 40-year period, which means that when he's 65, he's put in there a total of $200,000, and his savings account has more than 1.1 million. Of course, he's the one that's better off than versus Susan and Bill, because he was very consistent, but he also started the earliest, right? So the message, guys, is there's no better time than today to get started. It's never late, but just get started today. And this doesn't apply just to property investments, to any types of investments that will give you a return on your money, okay? So as long as you're getting a return on the money invested, just get started today. Now, I chose property, and I want to share with you the 3 reasons why I chose this type of asset class. And for the first explanation, I'm going to use a comparison, not sure if it's great or not, but I like it, which is batteries. Properties and batteries have something in common. So when we think about a battery, it stores chemical energy, and whenever we need electricity, it converts that chemical energy into electrical energy, right? So it has the capability of storing and flowing. For me, properties have that same, give you that same constant stream plus storage, okay? And that's one of the things that I like the most about property. Now, the second reason why I choose property is because it has held true over centuries. I have friends investing in different types of things, and some of them will start selling products in Shopify, and it's proven to work. I'm not saying it isn't, but Shopify is very recent. Who knows whether in 20 years' time it will still be around, because change happens all the time. Now, everyone needs a place to live, and population is growing exponentially, so there will be an even more of a shortage in properties in the future, and everyone will still need 50 years from now a place to just have a roof on over their heads, right? So I know it has existed over centuries and it will keep to exist in the future. And finally, it is the number one proven reason for wealth, right? So those are the three main reasons why I choose property. Now, there's also three big benefits that properties give me as an asset class that other investments don't. The first one is the power of leverage. So leverage means using other people's money, and it could be the bank or some other form of getting money from somewhere else, where when we think about property, I need to come up with whether it's a 20 or 30% deposit, and the rest could be lent to me, right? So not only is it being lent to invest, so I only come up with a percentage of what it's worth, but if I'm renting that property out, that rental income will pay my debt. So actually, I'm not even paying for the remaining of the value of the property. So if I think about investing in gold, in assets, in shares, whatever it is, I haven't found a way in which someone will lend me money just to come up with 20, 30% of that value, and then the rest will be paid off by someone else, right? So that's why property has an amazing advantage over other asset classes. The next reason is that if you do it right, it gives you a really high return on your investment, right? And when I say what is high, for me, double digit, so 10% and above, is a really good return on your money. Okay, so how much you're getting out versus how much you put in out of your bank account, out of your pocket. And that's amazing. The third reason is that there aren't that many asset classes that will benefit from inflation. So when we think about properties and markets that are pretty developed and stable, a healthy inflation would be a 1.5 or 2% annual inflation. And when you have that type of inflation, it's very normal to see the prices of properties going up, the rental income going up, and some of your expenses also growing because of inflation. What happens is that your biggest expense will be your loan or your mortgage. And it's very normal that over the life of your mortgage, for that interest to remain pretty constant. So inflation is actually helping you, because if the value of your property is going up, if your rental income is going up, and some of your costs are going up, but your biggest expense is staying constant, then inflation is actually helping you. And that's one big benefit that I cannot see materialize with the other asset classes. Now, you can ask me, like, this all sounds great, but can things go wrong with property? Yes, they can. And we've all lived through the 2009 world financial crisis. Now, you can be prepared, and by acquiring knowledge, you can mitigate your risk. So if you wait a little bit, in a few upcoming slides, I will be sharing what savvy and non-savvy investors did, and how the savvy ones actually did okay during the crisis versus people who lost a lot of money, okay? And this is coming in just a few slides from now. So let's start talking about cash flow. And what is cash flow? It's just money coming in and money coming out, okay? So it's income minus expenses. And when you have a property for rental income, your income will be that rent that comes, whether it comes every week, every month, fortnight, or whatever it is, in whatever period you're being paid, your rental income. And then you will have to pay expenses. So if you got a mortgage, then you have the mortgage payments, then you could have insurance, management fees, council rates, things that break, and other costs, okay? Now, there's two options here. There's the option where your cash flow is positive. That means that your rental income is covering all of your expenses, and then money is coming into your bank account every month. And then there's the option where your cash flow is negative. That means that your rental income isn't enough to cover for all of the expenses of the property, and you have to put out of your own bank account money to cover for the expenses of this investment property. Now, when you have a positive cash flow, we're going to call it positive gearing. And when you have a negative cash flow, we're going to call it negative gearing. So again, positive cash flow brings money into your bank account. Negative cash flow takes money out of your bank account because your rental income isn't enough to cover for all of your expenses. And I will be showing you right now in the next upcoming slides 3 different real properties and showing how some of them can be positive and some can be negative. Now, in order for me to show you the cash flow calculations, we do need to know a few other things to be able to properly calculate cash flow. So the first one is LVR, which stands for loan to value ratio. And loan to value ratio, in short, is what percentage of the purchase price will banks be willing to lend you. Okay, so for doing very simple calculations, let's assume we have a property and the purchase price is $100,000. If the loan to value ratio is 70%, that means the bank will lend me 70% of $100,000, which is 70K, and I will have to come up with the down payment or deposit for the remaining 30%, which is $30,000. Okay, so that is the loan to value ratio, which I also refer to as LVR. Now, then you also need to calculate the mortgage payments. And I'm going to give you a warning right now. I'm going to keep it simple. How I'm going to show you how I calculate my mortgage payments is not necessarily the right way, but it's close enough to reality and simple enough for this type of webinar and explanation. Okay, so just be mindful that this is not exactly how you would calculate a mortgage payment. So to keep with this example going, and I'm gonna just put the spotlight so you can follow me. So we have the mortgage. So we just said that we were gonna be lent $70,000. And as an assumption, I'm gonna take the interest rate to be 5%. So I can calculate my annual repayments to the bank as in annually, monthly, or weekly, okay, or whatever we choose, but I'm going to show you how I would do it. So if the interest rate is 5% per annum, that means that in 1 year, I'm going to return that 5%. So I'm going to multiply the 70,000 that I got lent times 5. And in that year, I would be paying the bank back $3,500. Okay, so this number here. Now, if I wanna calculate how much I would pay per month, because there's 12 months in 1 year, I simply divided this number times 12, and I get that the monthly payments would be $292. Now, it could be that you want to know weekly what you're gonna be paying the bank, and then instead of dividing it times 12, because there's 52 weeks in 1 year, I'm gonna divide the $3,500 divided 52, and the weekly payment would be $67, okay? So I'm gonna keep the upcoming examples as weekly cash flows. So that's why you'll see me take the loan, multiply it times 5%, and then divide it times 52 to get the weekly payments to the bank, okay? So let me just keep going with my explanation. And in order to introduce the positive and negative gearing examples, I'm going to share a personal story. This is something that happened to me. So in 2018, when I shared I was going through this whole self-discovery journey, I started becoming very eager, which sounds way cooler than desperate, to leave my job. I had been working at this job and I knew it wasn't right for me, and I was getting more and more unhappy about it, okay? So I signed my partner and myself to a property investment workshop, and this workshop was coming in the next couple of months. And in my eagerness, I started contacting people, and I got introduced to someone who was called a sorcerer. So I didn't even know what his name was, that his name was a sourcer and what he did. But a sourcer will look for investment deals and they package them and present them to investors just like yourself as a package, right? And it's up to myself as an investor to understand whether what I'm being presented is a good or bad opportunity. Now, this sourcer, he understood that I didn't have a lot of knowledge, and I was looking forward to this workshop and understanding a little bit more. And what I was trying to explain without knowing it was called positive gearing is that I wanted money coming into my bank account every month. I didn't want to be losing money every month. Okay. So he actually presented a similar property to what you have on screen, but when I tell you the story, you'll see that most of them look the same. So basically it was an off the plan or turnkey type of deal. Basically, it's not built yet. You put a deposit and it will be built in the next year or two, and they offer it at a discount price. And this property was being presented to me. So I currently live in Sydney, Australia, and this property was in Queensland, which is a little bit up north in the eastern coast. So it was way more affordable than the Sydney market, and it looked amazing. I actually flew up there to check out a similar type of property, and it looked so good that I would have wanted to live there myself, to be honest, right? So to me, it looked amazing. I was like, yes, looks like a great deal. Let's move ahead. We put $1,000 refundable deposit, and basically, this is what happened. It was very timely because we were 2 weeks, this was 2 weeks before going to this workshop that I had signed my partner and myself up for. And we had access to a 20-minute phone call with a mentor. And this phone call opened our eyes, really. He said 4 things that made us realize there was another side of the story that from what we were being sold by the sourcer, and he was doing an amazing sales job with us, but we were missing a lot of information. So he started by saying, I congratulate you because you're taking action, and most of the people don't ever get started, right? So no matter what, whether it's a good or bad investment, I congratulate you for taking action. That's great. Now, let me tell you the first important lesson, which is you don't make money when you sell, you make money when you buy. And guys, this opened my eyes completely because it doesn't just apply to properties. It could also apply to shares, okay? So when you buy shares or properties, you want to buy at a discount or below the market average. If you are buying above the market average, and I'm going to show you again with my spotlight. So let's say that you are buying above market average. Let's say that we buy here. Then what happens is that we will only make this difference, which is not a lot when we sell, or we have to wait a whole new cycle. And even by waiting quite a few years and having our money stuck in there for that period, we would still make this of a difference, right? It's not that much. Now, if you are aware and you understand that it's so important to buy at a discount because you make money on the buy, then you want to be buying sort of around here so that when the expansion happens, you actually, when you sell at the high, you have made a lot more money, okay? So that was the first thing. Now, because it was an off-the-plan deal, and even if we're being sold this as a discount price, there's no discount because the property doesn't exist, okay? So that was the first big issue with the property that we were being presented. The second issue was that things can go wrong with property investments, and you want to ensure that you have at least 2 exit strategies whenever you go into a deal. Now, if you buy things that are a little bit run down or very run down, then you can go and paint, add new carpets, do a renovation, whatever it is, force appreciation. And then let's say that you were buying these for rental income, but for some reason you need to get out of it. You can go and sell without losing money because you just forced appreciation, right? Now, when you're buying something as a turnkey or off the plan, it's completely new. There's very, very limited things you could do to be able to add value, right? So you want to make sure that you can add value as a possible exit strategy. Then the next thing is, we were being told in our faces that this place was in a location in a suburb called Coomera, and they were telling us we will be massively developing these, and the location sounded amazing, and for sure in the future it will go up in value because they were about to inaugurate Westfield, which is like an amazing shopping center, like huge company. So for sure, if they're opening a Westfield 5 blocks away from where this property was located, then in Westfield has done their maths and invested like millions because they believe that the potential is there and that market will be highly developed and grow. However, what is happening is that whilst they're developing, they're introducing a lot of new houses and units. So we were after a house, but there was a whole plan to do a lot of units as well in there, which means that if you go and look at a demand and supply curve, and one more time, I'm going to use my spotlight, they were introducing a lot of, the supply was shifting the curve, okay? So it was going from S1 here to S2 there, okay? Which means that in that short to medium term, the prices would go down because that's how demand and supply work, right? So they were promising me a certain rental income, and they were selling to me at a discount, a purchase price of this property. But I knew that because they were massively developing, in the next few years, most likely prices would go down for both rental income and the value of the property, which means that even worse, because more people would want to go and sell their own properties if they're not receiving enough rental income as they got promised. And that would make it even less appealing. And the fact that I cannot force any appreciation because it's a completely new property would put me in a very difficult situation. But finally, last and not least, the most important issue with this property being presented to me is that even if I was trying to explain that I wanted money coming into my bank account, when the mentor heard some of the top line numbers that I was mentioning, he was like, Tiffy, without running any numbers, I can already tell you that this property won't be putting money into your bank account. It will be taking money out of your bank account, okay? So you wanna make sure that you're not getting yourself into a very difficult situation. And that's when I said, okay, I need to get out of this. I chased for a whole month for my $1,000 deposit to come back to me. And after a lot of chasing, I got it back. But yeah, that's how I introduced myself into this world. And I want to share this story with you guys because I want to make sure that you don't go through that same situation, or even worse, get into something that you thought would go one way and it goes the other way. Okay, so let's get into 3 real life examples about positive and negative gearing. And I'm going to start by sharing this property, which is a property based in Coogee. So the reason why I chose Coogee is because I live and I rent. I don't own the house I live in, the unit I live in Coogee. So Coogee is in Sydney, a lovely suburb. Okay, and this property got sold in May 2019 for $1,325,000. Now, shockingly enough, the last time they had sold this property wasn't that long ago, but Sydney has seen a massive growth in prices, and it had been sold in 2012 for $153,000. So you can see how there's been a massive growth in the purchase price, in prices in general. Now, they were providing, at the time they were putting this property to be sold, they were providing the last rental income as $975 per week, and that had been perceived in October 2018. We're talking about an apartment, so it's a 3-bedroom, 1 bathroom, 1 garage. And I'm gonna start introducing 3 assumptions. So guys, these 3 assumptions that we have here, I've kept them constant for the 3 examples I'm going to show because I want to be fair and not be changing variables. So we've already talked about loan to value ratio. So across all 3 examples, we're going to assume that the bank lends us 70% of the purchase price, and we're going to take the interest rate as a 5% per annum. Now, the other assumption is that on top of the mortgage repayments, there will be other costs, okay? And I'm going to repeat, but those other costs could be insurance, council rates, property management, things that break, etc. And I'm going to keep these other costs constant, which means that it's these other costs that I'm taking as $160 per week are actually more in line and realistic with the 3rd example that I will be showing you. And without running any numbers, I can tell you that for this particular property, you should expect these other costs to be double or triple $160 per week, okay? But for fairness of comparisons, I'm gonna keep them as $160 per week. So if we take the purchase price of $1,325,000, we will have to come up with a 30% of that amount for the down payment or deposit, and that is almost $400,000, so $397,500. Now, the bank will lend us 70%, which is the $927,500. So as explained a few slides ago, how I'm going to calculate my weekly mortgage repayments is I'm going to take that mortgage amount, I'm going to multiply it times 5% and divide it times 52 weeks in 1 year. So here you have that math. And this number is 892, which you have here on this weekly cash flow. And this is the focus of what we're looking at, okay? So we have rental income as $975 per week. We are paying the bank $892 per week, and we're spending on other things $160 per week, which means that we're losing $77 each week. And for some, it might not seem like a lot, but when you realize that in a whole year, so if you now take this number into 52 weeks in 1 year, you're losing $4,000 a year at least. Remember that I said that probably the other costs are way higher for this property, so you would expect to lose even more than $4,000. But the cash flow is negative. Every week, you have to take $77 out of your bank account to cover for all of the expenses because the rental income isn't enough. Okay, so this is a negatively geared deal. Now, let me just keep going into the next screen. This second example is the actual example I got presented by the sourcer. Okay, so it's also negatively geared. This is the property I was referring to in Queensland, Australia. And you can already see how it's way more affordable versus the $1.325 million property in Sydney, right? It's for almost $415,000. So they were also providing me with a rental appraisal, which meant that I go and buy this property for $414,900, and each week I would get $400 per week in rental income. It's a 3-bedroom, 2-bathroom, 1 garage house. So again, keeping the same 3 assumptions constant, the bank will lend me 70% of the purchase price at a 5% interest rate per annum. And I'm going to assume that I would have other costs on top of the mortgage repayments of $160 per week. So let's try to first figure out how much we need to take out of our own pocket to cover for the deposit. And that's 30% of the purchase price, which is $124,470. And then we will be asking the bank for 70% of that purchase price, which is $290,430. So again, if we take that amount and we want to calculate the weekly repayments to the bank, we'll multiply that number times 5% and divide it 52 weeks. And that will tell us per week how much we're paying back. So again, let's work our weekly cash flow. We have $400 coming as rental income. We're paying the bank $279 each week. And we have other costs from insurance, council rates, property management, things that break, etc., for $160 per week. That means that we're losing $39 per week. So okay, when I multiply it times 52, that makes it a $2,000 loss per year. So already we're losing half of what we were losing versus the Sydney example, but it's still negatively geared. Now, there's a lot of people who actually find this very appealing, and I want to show you what they see as appealing with this type of properties, okay? So what the sourcer was trying to sell to me, and his selling story for this negatively geared deal, was that I could actually claim back some of our taxes. So what happens is, depending on each country, how the law works, but many governments around the world will allow you, if you have an income because you're working, and let's assume that you're paying 30% of your income, it's going as taxes to the government. If you have then a rental property that loses you money every week, every month, every year, then the government will allow you to claim some of those taxes back. So you would get a refund, a tax refund, okay? And what he was trying to explain is that even if I'm losing $2,000 in a year, I could actually claim $3,000 back. That would make it an annual surplus of $970. So almost $1,000 coming back to me. So that was what he was trying to sell as cash flow, but we cannot call it cash flow. That's not cash flow. That's a tax saving that comes as an annual surplus, okay? So still a negatively geared property, and some people will think it's good to buy negatively geared and then claim taxes, okay? Now, before I explain what worked and didn't work for me from a positive or negatively geared type of deal, I'm going to show you now a positively geared property. And sorry, this shouldn't have changed. And this one is special because it was the first property I purchased. Okay, so this is mine, and it's not 100% mine. I did it with investors, so I don't own all of it. I didn't have to come with all of the money myself, but a percentage of this property goes into my bank account every month. So this property we bought in January 2019 for $167,000. So actually it was 166 something, but for ease and simplicity of calculations, let's keep it as a round number of 167K. Now, in all fairness, we went and did a massive renovation. So we converted this from a 3-bedroom and 1 bathroom to 5 bedrooms and 2 bathrooms. So we went and spent $80K to be able to do this massive renovation. And we're receiving rent of $520 per week. Okay, so we got this house revalued in July, and probably I'm gonna get it revalued again very soon. And it was already worth $255,000 at that point in time. Okay, so first things that I want you to notice: the prior deal that I showed you, the one that I almost bought in Queensland, was worth 415K almost. Okay, so more than double this property, and the rental income was $400 per week. We're getting $520 for this one, which was less than half the price. Okay, so very important to recognize that there will be deals that will be way better than others, because what you're spending in the purchase price versus what you're getting in rental income does play a significant role. So it's not just about how much money you spend on your deposit and the full purchase price, but also how much rental income you will get for it, okay? And that's the importance of acquiring knowledge and learning how to find the good and the bad places. So again, one more time, I'm going to keep the assumptions constant. So the bank will lend us 70% of the purchase price at a 5% interest rate per annum. And we will have other weekly costs of $160. Okay, so For the deposit, we would have to put 30% of the purchase price, but I've also added here the 80,000 of the renovation. So you understand that out of our bank account to be able to make this happen and receive $520 per week, we did have to spend $130,100. Okay, now the bank lent us $116,900, and when we want to calculate the weekly mortgage repayments, we multiply 116,900 times the 5% divided 52 weeks, and that's $112 per week. So every week $520 come in as rental income, we pay 112 as to the bank, and then we have other costs of 160, which means that every week we are earning $248. Okay, so we could choose here annually to lose $4,000, lose $2,000, or actually earn almost $13,000. And that's a positively geared property, guys. And again, it's okay. Everyone has different strategies. For me, this one was really appealing versus the other types of opportunities. And let me explain, before explaining, let me show you a few things to bear in mind. So a gross figure is something that takes into account only the income, but not the expenses, okay? So if we're only looking at rental income without considering whether the expenses are high or low, then the first opportunity, the Coogee one, would have been the one with the highest gross income, because you were getting the highest rental income of $975 per week. However, the cash flow was the lowest, so you were losing $77 per week, okay? So having a high gross income doesn't necessarily mean that it's a great deal or a great opportunity. Now, out of the three examples I showed you, the third one had the middle rental income, but the best cash flow. So not necessarily the highest gross income, but definitely the highest net income. So a net income would be when you take your income and bear in mind your expenses, okay? So you're considering your expenses as well. I'm not saying that you should only focus on net income. I do look at both gross and net income, but net income plays a massive role because cash flow is king. Remember that, guys, cash flow is king. Okay, now I'm going to show you what my first deal looked like because I'm very proud, but I want you to start visualizing how this can work out. So on the left, you have two images of the before. So this house has a room. This room is the one on the front left, and it had a walk-in closet that connected to another room to the back of the house. So what we did is we painted, put new carpets in there, and the walk-in closet, we converted it to a second bathroom. And on the right, you can see what it looked like after the renovation. Now, it had a massive living room, and we decided to do two things. Of course, on top of making it look nicer, we also divided that. So you can see on the bottom left part of the screen that there's a window, and moving windows would be very expensive. But what wasn't expensive was moving that wall. So we placed a wall right next to the living room, and the front part of it, we converted into an extra bedroom. Okay, now the kitchen, you can see the before and after, and looks really nice after the renovation. And now I'm going to share with you why I wanted positive gearing. Now, we're all different, and we might have different objectives in life. For me, once I figured out my life purpose, I wanted to start doing things that would fulfill my purpose. And some of them will bring some money in, and some of them won't. Okay, so I wanted to start generating a passive income stream so I could gain a little bit of freedom and not be constantly worrying about having to pay the bills, and be able to choose to spend some of my time doing some activities that fulfill my purpose and will bring some money in, and some activities that won't bring some money in. Okay, so I needed passive income to fulfill my purpose. I also wanted to have rental income and then pay all of the expenses and then leave some extra money to keep reinvesting it into building my portfolio. So instead of me having to come up with the money every single time that I want to invest in a new property, I have a property that is generating money. So it keeps self-funding and self-generating and building my portfolio, okay? And finally, we all have the choice. If I think about the company I'm creating, about these courses, now I could choose to create a business where I win money, or I could choose a business where I lose money and then deduct taxes, okay? I choose to win money if I have the choice. So with my properties, it's the same. I have the choice of winning or losing money, and I choose to win money every month. That's why I wanted positive gearing. It's okay if you feel different about it. Now, there were three big reasons why I didn't want negative gearing. And the first one was I knew I was going to take a massive jump, leave that stable income that I had for the last 7.5 years. And therefore, I couldn't afford to increase my cost of living. So I needed to keep my cost of living as low as possible because I was going to be going through hard times. And on top of that, when we think about how the banks choose to lend you or not money, one of the things they look at is your capacity to service the debt, okay? So do they consider that you can afford paying the weekly or monthly mortgage repayments or not? And if they see a high risk that you won't be able to pay them, then you don't have the serviceability to ask for a loan. Now, for me, I want the sky to be the limit. So when you have positively geared properties, what the bank starts seeing is that you have more and more money coming into your bank account. Now, if you have one negatively geared property, already they start seeing how every week or month you're losing money, and they will struggle to give you a second loan. And that's fine. Maybe you get a second loan for a negative to have one or two negatively geared deals. But no matter how big your income is, probably by loan number 3, they won't lend you any money because they see a high risk on you not being able to service your debt. Because if you were to lose your job, even if it's a great high paying job, the moment you lose your job, you still need to start to generate an income to cover for the cost of that property, because your rental income is not enough to cover itself, okay? So for me, I didn't want negative gearing because I didn't want the banks restricting me on how many loans I could get. And finally, I was actually planning on leaving my stable income, leaving my job. I told the sourcer I will be quitting my job next year. So once you quit your job and you don't have a stable income, you're not paying taxes. So the whole negatively geared strategy where you get a tax deduction, in order to get a tax deduction, you need to be paying for taxes. The moment that I no longer pay for taxes, there is no taxes to deduct. So it didn't work for me. Okay, guys, again, I'm just mentioning what my journey has been and what things I saw as positives and negatives and why I wanted positive gearing and I couldn't afford negatively geared deals. But again, everyone is different and what works for me might not work for you. So I'm now gonna fulfill on my promise on explaining what happened during the world financial crisis. And for that, I'm gonna explain how a lot of people invest. So when you buy gold or you buy shares, you are buying those asset classes hoping that when you sell, you will sell at a profit. Okay, the price would have gone up and you're selling at a profit. Now, any scenario where the market has gone down, then you'll be losing money. And a lot of people who call themselves investors, whether they're investors or not, it's not under discussion, but they were buying property thinking, I buy at this price, hoping that the market will go up, and so I can sell at a profit. Now, they were buying properties without understanding how to run an analysis and not realizing, or maybe realizing but not understanding the full impact of what it means to be losing money every week or every month, of having a negatively geared property. So when a crisis comes, a market starts decelerating. People start spending less money and there's less money on the streets, right? So less people go to the coffee shop. So the coffee shop will need less employees. And what happens is a lot of people start losing their jobs. Now, if you lose your job and you have an investment property and that investment property is positively geared, then that's fine because you're still putting money into your bank account every month and you don't have that load that you have to pay for a difference that otherwise, if you didn't have the property, you wouldn't have to pay. So you're not raising your cost of living. Now, a lot of people bought properties without understanding how positive and negative gearing, what they mean and what cash flow is, and whether they would put money or take money out of their bank accounts. And when the crisis came and they lost their jobs, they first started, you go on survival mode, right? Like you first will cover with whatever money you got left in your savings, your own meals. You'll trade, if you have your own home, you'll try not to lose your home. And the first things that you stop paying for are the mortgages of your investment properties that are losing you money every month. So that's how a lot of people lost their investment properties and lost a lot of money, because they had bought a property hoping that the market would go up. And no one has the crystal ball. No one can predict whether a market will go up and down, and things can go wrong. But if you have a positively geared property, then even when the market is going south, you still have money coming into your bank account. And to be honest, there's less of a risk of you not having it rented out, because when people start losing their homes, the demand for rental properties goes up. So actually, in moments of crisis, there will be an even higher demand for rental properties, okay? So going back to that last final point where I wanted to share with you how you make money in growing and declining markets and how to avoid losing money when a crisis comes, is cash flow is king. And you are wanting to understand, even before putting offers, how much money will be coming into your account and how much money will be coming out of your bank account, always hoping to be making a profit, okay? And not just a tiny profit, because interest rates could go up or things could go south, but when you've done your calculations and allowed for a really good profit, even when things go the wrong way, you still have cash flow coming into your bank account every month. Now, if your strategy in property, you could actually apply two strategies really. One is buying properties for rental income, and another one is buying properties for capital growth. Okay, so the ones for rental income, I call them buy and hold or buy to let. Okay, let is to rent. So my strategy is buy and hold, and it doesn't mean that I won't go and do a few flips. So basically, I never want to run out of money. And even if my strategy is buy and hold, after a couple of deals, I might go and buy a property to make it a flip. That means that I buy a rundown property, I renovate it, and I immediately sell it. So I have some money, a little bit of a bigger influx of money coming in to keep funding my next buy and hold. Okay. Now, if you're doing buy and hold, then you want to make sure that you're doing whilst the market is expanding, okay? It doesn't make sense to be flipping if the market is in a recession, because even if you're buying below market value and forcing appreciation right away, if the market is declining, even with all of the value you added, maybe you still sell at a loss, right? So you only want to do flips when the market is expanding. Now, if your strategy is buy and hold, you can actually make money on growing and declining markets, okay? So flips only during expansion, buy and hold during expansion and recession. And that's how you make money in growing and declining markets, okay? So let me go. What have we covered today? So we already understood that today is the best time to get started with your investments, no matter whether they're property or any other asset classes. Now, I've told you why I chose property and the three big benefits that I couldn't find in any other types of asset classes. With that information, you should start having a sense on whether you believe property is the right asset class for you. The third thing we saw is what means positive gearing or positive cash flow, and what is negative gearing and negative cash flow. And I've given you a few reasons why I choose properties that are positively geared, and why I needed to stay clear from negative gearing. Again, there's no wrong or right, and we're all different. This is what worked for me, and I'm sharing it with you. You should be able to make your own mind on which strategy fits you best. And finally, how to earn money in growing and declining markets. Now, I do have an offer, as I mentioned at the very beginning. I've put together a course called Grow Your Property Investments and Work Because You Want to. And the idea of this course is to give you knowledge that you can immediately put into action and start generating profitable passive income streams. So it's about doing exercises where you understand how I calculate cash flow with real properties on the market. So then you can follow the same steps every time and go and put offers and buy your first investment property, right? So it's all actionable exercises. I offer this course in two formats: as a face-to-face 2-day intensive course, or 8 1-hour online sessions. Okay, so guys, the first property is the hardest you'll ever make. And I'm here to guide you every step of the way and inspire you, push you, so that it's not easy, but with the right coaching and inspiration, you can get there way faster, right? So let me talk to you about what we'll cover in that course. So we'll first look at how to search and select the best areas with the most potential for capital growth. So even if I never ever rely on capital growth, it's the cherry on top. So my business case is all around the cash flow, and any capital growth is the cherry on top. I always make sure to be searching for the areas with the best potential for the market to be going up and my properties appreciating. I will teach you how to create a strategy that is self-sufficient and self-generating. So every time you want to keep going, you don't necessarily need to raise all of the money for the deposit all over again, but with some of your prior rentals together with remortgages, you can start funding your next investment deals, and it becomes way easier once you get started. Now, I will teach you where and how to find these amazing deals where you're getting a really good rental income and the purchase price isn't that unaffordable. Of course, you will learn to distinguish what's a bad, a good, and a great type of investment. So not only to search for them yourself, but many times you're going to be presented with opportunities, and you need to understand yourself and make a decision on whether what you're being presented is good or bad. I'm also going to show you how to run a detailed analysis, including understanding the monthly cash flow, but also calculating return on investment and yield. I know when I say the words return on investment and yield, they sound fancy, but actually once you learn how to calculate them every time, they're very powerful. So the return on investment will allow you to understand whether this type of investment versus any investment, whether it's in property or gold or shares or whatever, is better or worse, and you can compare against any types of investments. And the yield allows you to understand if the rent, which is that gross income, versus the purchase price is good or bad. Okay, so I'll teach you and you'll become fully proficient at calculating this yourself. Then we will cover on working the full cost of the property, because I wouldn't want you to get involved in a deal and halfway through realize that you've run out of money because you hadn't accounted for many things, right? So we'll look at all of the costs involved, how to set up a system on autopilot. Now, we're creating all of these to have a passive income, not to be working full-time and extra hours on our rentals. So you need to put together a power team that is solving the issues that come up without you having to constantly be there, right? So I'll teach you how to put a power team together, understanding the full buying process with expected timelines, key milestones, how you call a real estate agent, ask the correct questions, and you can actually negotiate the price. So the properties I bought, they were published at a certain price point, and I was able to buy them below the price that they were asking for. Now, that required negotiating skills, and that's a really important part that I can teach you and help you navigate through. And finally, most importantly, creative ways on how to raise funds, because you don't need all of the money nor having any prior experience to get started. I didn't have experience, I didn't have the money, and I was able to start. So I believe this course will be a great fit if you're looking to start creating a passive income, and not just a passive income, but a profitable one, a good return on your money. If you believe that property is a great way to start an investment portfolio, if you understand that the first few months of setting up a system require hard work, right? Guys, this is not easy. I'm not saying it's easy, but I can help you make it easier for you, and you will have to put your effort into the first few months of setting up the system. And you are willing to delay some rewards. So at the beginning, you will require to keep your expenses low and build your assets first. And once money is flowing in, then you can grow your expenses and live whatever type of luxury life you want. It's not up to me to judge whatever you want to live, but you will have to keep your expenses low at the beginning. So great fit if you're certain that you're ready to take action and you choose to make money every month, right? Now, I don't think I'll be able to meet your expectations if you're looking for quick and easy money. This is not it. If you're happy with losing money every month, then I don't think you need my help. If you're not open about learning new ways of doing things, or you're very set and emotional about buying your own home right away, especially in an unaffordable market, then I don't think this is the right time for you to be making this workshop. And finally, if you are currently starting your own business, then most likely you won't have the time, energy, or money left. So I'm not saying this course isn't right for you. I don't think the timing is right. So probably you will need to spend all of your time, energy, and money on your own business. And once that's up and running and your own system is created and moving forward, then I recommend that you come to this course. Now, remember how at the beginning I asked you to think about what's the one thing you want to start doing or do more of? I want to help you achieve that. And I think this course will allow you to start creating a profitable passive income stream, so you start gaining that freedom of choice. So today I'm gonna offer you a deal. First and foremost, I wanna offer a 20-minute free consultation with myself, okay? So each one of us is unique and different, and you will have your own goals and be standing in your own particular situation. So what I want to hear about you, and I want to advise what's best for your situation right now. So there's so many people I can actually advise at a certain time. There's just me. So this offer of a free 20-minute consultation will be out there for a limited time only. And if you purchase this course within 48 hours of watching this webinar you're currently watching, then you will get the free 20-minute consultation with myself. As well, I want to mention that the course will be going up in value. So right now, the online course is available at a launch discount of $49.99 Australian dollars, and the face-to-face course is available for $199.99 Australian dollars. So the course will still be available in the future if you don't want to go ahead right now, but it won't be this amount. It will definitely go up in value. So don't miss this opportunity. Get into it. Start taking action today. And guys, if you're thinking all of this is great, I'm still not entirely sure if this is the right course for me, then I encourage you to go into a web browser right now and type what you have there on screen, bit.ly/thinkerfree session. It will take you straight into one of the 8 online sessions for free, and you can check it out and see whether it makes sense for you. You like my style, how I teach things, you see value in what you're watching, and you think you can action it right away. Now, there's 3 reasons why people will choose Finke's course, Grow Your Property Investments and Work Because You Want to. First, they find it enjoyable and inspiring. I keep it simple, so I don't want to be overwhelming, and I teach you the step by step, which I replicate every single time I'm starting the search for one of my new properties. Second, it gives you the confidence to take action. So everyone who's come out of my courses has told me, Tiffy, like, now I feel like I can go and make this happen, and I trust myself. I have the confidence. I'm not hesitant about whether it's good or bad, because with the amount of knowledge you'll have, you'll be able to distinguish good from bad. But also, there's so much knowledge that it will give you the choice of picking and choosing what's relevant for you. And finally, it develops their creative skills on how to invest even when you don't have a lot of savings. Okay, so you get to see how I started with not a lot of money, and how I've used already a few different creative ways to raise funds. And you can also go and make it yourself. You can go and raise money. I'm not special, so if I can do it, you can do it, guys. So that's what people who have come to my course have, what they say is the best out of this course. So here you have three options, three choices really. So you could decide not to do anything and keep living your life as you're currently living. You could decide to go and do it yourself, and there's nothing wrong with that. Or you could decide to do it the smart way. So it's not easy. And by acquiring knowledge, you will be able to manage risk, but also avoid very expensive mistakes, really. And what I can guarantee is that what would take you years to achieve, with the right knowledge and push, inspiration, coaching, whatever you want to call it, you could achieve that in a few months. No, it's not going to be becoming rich overnight, but I'm certain that with all of the knowledge I can give you, you can take that, and whatever would take you a few years to do it yourself will happen in a few months. So guys, if you want to go into the online course and purchase right away before your 48 hours are over and you miss your chance of getting this great price and a 20-minute free consultation with myself, then you can type bit.ly/finkecourse and it will take you there. Otherwise, you can go onto the website and just navigate it. There's tons of information in there. So just visit finke.com, or you can reach out via email to info@finke.com. Thank you so much for watching this webinar. I hope that you've learned something, and to see you around. Really hope that you can start creating some freedom of choice. See you soon.